has a fractured fibula. Well, so I can be able to go on tomorrow.
Daddy's gonna be so excited.
That killed him.
Paging Dr. Palmer, Dr. Barbara Palmer, dial 452.
She sings this tonight. I know. Hey, Dad, whoever. We need to go.
Oh, honey?
Here's some money. What do we got here? I'm her daddy.
Look at the cute dog.
Well, last one was a little aggressive there. That's all right. Let me switch my screen around a little bit. All right. Well, hopefully those were funny. You know, I remember those. From,
I remember a lot of those.
Right? Don't you remember those? That is hilarious.
Yeah.
Well, Holly, thanks so much for joining us today. How are you doing?
I'm awesome. Thank you.
Well, awesome. Well, I look forward to talking to you. I'm going to just introduce you a little bit and then we'll dive right into it. So I have known Holly Stirling for, man, we keep going over this whenever we meet with new people. But so back in the day, I used to be a sales agent at Ivory Homes. This was from like 2000 to 2004. And back then, you know, I worked out at the West Point Farms out in Rose Park sales model. And so Holly was my like designated loan officer, like the affiliated loan officer arrangement with First Security Bank back then, right? And so
Yep.
Holly would come and sit at the model with me, you know, 20 years ago, and we would pre-qualify people on 8%, you know, FHA loans back when we had the Nehemiah Gold and the Neighborhood Gold and all those like funky grant programs where you'd kind of funnel down payment money to, you know, to the borrower. So anyway, so I've known Holly forever and she's personally done, I've lost track, you know, 30 plus, if not more mortgages for me over the years. And she's always been my go-to. Holly's now at Greystone Mortgage. And I actually have my mortgage license to do my hard money loans with Greystone Mortgage. And so we've kind of continued our networking and relationship over the years. So I mean, there's a ton of good lenders out there, but I've yet to find anyone as professional and thorough and complete and time sensitive with deadlines as Holly. So Holly's been in the mortgage real estate industry for 28 years. Her time in the industry, she has filled many different roles, from real estate company admin and accounting, back in the day when you had to drive to the board and pick up the book instead of having the MLS. She's been a home builder developer, setting up new subdivisions from start to finish, realtor, mortgage loan processor, mortgage loan closer, even back when you actually had to typewriter the names and addresses and legal description on the deed. Wow, that is not efficient. Mortgage loan funder, when you had to actually type a check and walk it to the bank to wire funds. Mortgage junior underwriter, junior loan officer, mortgage loan officer, senior loan officer, and branch manager. So with her extensive background in almost all aspects of the mortgage and real estate industries, Holly has a deep knowledge of guidelines and the ins and outs of tricky files that make files fail. She spent time traveling with an investor group teaching lending basics to a room of 800 plus investors. She's been the preferred lender for a local large builder. She's been managing a mortgage branch while continuing to be one of the top producing loan officers in the company. With so many years of experience and vast job positions she has held, she is able to get things through faster and cleaner than almost anyone else. The most important thing is taking care of her client, making sure she helps them get into the right loan for their situation and goals, and doing it at the best possible rate. On a personal note, she has many hobbies and interests, including scuba diving, hiking, charity work, traveling, boating, camping, martial arts, snowmobiling, playing the violin and piano, and her 2 husky puppies, and of course her daughter. So I did not know about the violin and piano. I've clearly known about the martial arts, obviously the boating and the dogs, but you'll have to.
And I left the ballooning off of there too. Somehow I left ballooning off of there. I don't know how I did that.
Yeah, you need to put that on there because anyway, if you follow Holly on different social media, it seems like every day she's either with her dogs or hot air ballooning. And so always staying active and doing something, including a lot of loans. So what did I miss there in your bio that might be helpful to understand?
Oh, geez. I think you covered pretty much the gamut. The only thing I haven't done in the industry is I haven't been in the title side. I never have done the title industry, but everything else I've probably been involved, whether it was, and even in addition to that, my ex-husband was a builder himself, and he owned a construction company. So, we did a couple fix and flips ourselves. Matt, you were our agent on some of those. So, yep. Yeah, we've even had experience on the other end being an investor and flipping properties myself.
So this isn't really super relevant, but just more out of curiosity, I was thinking back when, our time at Ivory and First Security back in, 2000s, like I remember being so stoked to have an interest rate on my FHA loan at 8%, right? That seems criminal right now, almost as criminal as hard money rates, right? But, where have you, as you've done this for 28 years, what's kind of been the spectrum of rates that you've seen? Obviously I would assume right now is the lowest you've ever seen, but what's kind of been the spectrum to give some perspective?
Oh, I think the highest in my career has been like in the high 9s, like 9.75. I remember doing stuff, and back in the day when we had subprime lending, you would see stuff get a little hairy depending on, the transaction itself. So you might see stuff in the 10s or 11s if it was subprime. Maybe even 12, but, for a conforming interest rate, I'd say that low 9s were probably the highest I saw as a standard rate.
Yeah. Cool. Well, and then what are we at now? Like, let's start with like, how do you see the current mortgage environment today? What are rates? What drives rates? Maybe just give us like a, 5 to 7 minute, kind of mortgage for dummies, how it all works.
So the way I explain it to my clients, because I really am big on trying to educate the clients that I work with, anyone can drive on a I-15 and see a billboard with an interest rate. And those interest rates, I like to call them, this is my own word, but I call it rate porn, because it's something that catches your eye, but it's not true, right? And so one of the ways I educate my clients is I teach them what affects the interest rates. And I talk to them about the fact that the bond market, which is obviously usually the converse of the stock market, is where mortgage-backed securities go. So, if someone's going to invest in stocks, they're going to be pretty volatile. They're going to be up and down quite a bit. And if you've got an investor who wants to put their money somewhere that's a little more solid, that's not going to move, they're going to put it into bonds. And part of those bonds are mortgage-backed securities. And the way that works is, you know, I tell people, and it's not always the case because this COVID thing has really thrown our typical, you know, indicators for a loop. Because I used to be able to tell people, if you hear on the news the stocks are doing great, that's not good for mortgage interest rates, right? Because if we want to entice an investor to come and buy into mortgage-backed securities and they're killing it in stocks, they're not going to come invest. So the only way we get them to invest is we have to give them a higher yield on their investment, and that comes from raising the interest rates. So, you know, normally that's a very across the board easy way to tell people. That's been that way the whole 28 years of my career. The first time that's ever not been the case is right now. This COVID thing has thrown everything for a loop. So I normally have, you know, in fact, I think, Matt, you're probably on my email list too, but I have market indicators that go out to my realtors and my clients that are not locked on a daily basis and to my realtors on a weekly basis. And I've had to shut that off because the market indicators are not in line with what interest rates are doing. So really, I can tell you the big thing that's affecting interest rates right now is any news about COVID. So as they're starting, like yesterday, as there was news coming out about these, you know, possible vaccines and stuff, that was really good for the stock market. It actually helped the stock market. So we've seen interest rates increase very slightly, nothing massive. You know, went from maybe the lowest I saw was 2.875 on a 30-year fixed, and today I'm sitting at 3 1/8. I mean, who could complain about 3 1/8? But you know, that's what we're seeing as the economy stabilizes and as things come into play that are going to help the economy with COVID. That's not going to be good for interest rates. It's crazy, but in the mortgage industry, we love when the jobless claims are high. We love when things are going bad because the first thing they do is they drop interest rates. So, you know, right now we're sitting in a really strange environment where I can't predict from moment to moment, really. It's based on what news you hear.
Okay, no, that's great. That's a good quick synopsis. And so what kind of activity are you seeing? And then we'll get to some of the questions. Nate Worthen has a bunch of questions, which I were going to kind of cover all of these anyway. So this is great. What's your typical file looking like these days? Is it mostly refinances, purchases, or a mix of both? Or what are you seeing?
I'm about 60-40 purchase. Refi is about 60%, 40 is purchase right now. I mean, we're in a dog-eat-dog market again, multiple offer situation, you know, real estate booming here. Things are hot. So I have a ton of clients who are pre-qualified and who are out looking, but they're, you know, struggling. They might make 5-10 offers. You know, I just closed on one in the Harvard-Yale area yesterday, and that was like their 25th offer. And actually, it was one that had failed, and they came back to them because they were second in line, and that's how they ended up getting it. So, you know, I'm seeing it's busy in both avenues, right? Refis, it's almost a no-brainer. If anyone out there has mortgages and they're above, if they're 4% or above, they should be refinancing. It's literally a no-brainer. And what we're seeing is they've kind of eased the guidelines in some fashion, right? If you have income that's documentable, we're getting appraisal waivers on about 80 to 90% of the files we run on these refis. So I'm not even having to send an appraiser out. So other than being backed up because we're so busy, we're getting these things through so slick and so easy, it's ridiculous. But purchase-wise, you know, I closed the USDA in 2.5 weeks, which is unheard of. So we're still just we're killing it in this market. It's an awesome market. Like I've never been so busy. I just closed out yesterday my biggest month of my career in 28 years.
That's awesome. That is really cool. So when you speak, maybe for this call, and I know it's going to be different because an owner-occupant loan is going to be slightly different than an investor loan. Maybe since this is kind of more of an investor-focused kind of call, let's maybe try and answer a lot of these questions going forward as far as like from an investor mindset. Because one thing that I want to dive into, and maybe what I'll do is go to Nate's questions because they're going to answer, you're going to answer a lot of this as well. But I do want to walk through, and Tim Watkey was on a call earlier this month, and I know he's joining us right now, but he was become the master of like doing the BRRRR method on single family homes as well as on commercial loans. So I do want to kind of walk through the best way to think through from start to finish, really thinking from how it's going to look on the back end to how you need to set up on the front end for a BRRRR, right? That's going to be one thing I want to talk about. But then in general, like, you know, how all of this relates to investor loans. So maybe before we start with Nate's questions, which again are some of my questions, what what are some of the basics that an investor, just like housekeeping items, what are some things that you should always have ready as an investor so you can take advantage of either refis on current properties, doing a BRRRR, or just purchasing your first investment property?
So I'm gonna kind of back up and give some general guidelines that you need to know as far as investment properties go. So what we're seeing and what's happened with COVID is when we're dealing with, and this is going to kind of answer one of these questions that's up here, we have what's called loan level price adjustments, right? Things that are factors that affect the interest rate. So as an investor, if you're buying single family, the minimum has always been 20% down. We know there's some, other little funny loans out there with credit unions and such that are different, but the typical has always been 20% down, but we always saw a huge rate break if you put 25. So if you add that extra 5% down, if you're buying multifamily, 2 to 4 units, which after 4 units, it's no longer residential, it goes into the commercial world. But on the 2 to 4 units, it was always a minimum of 25% down. We saw the rate break at 30. So to kind of answer one of these questions at the same time, you're talking about fees. If you put that additional 5% down, fees are standard. I mean, it's just a 1% origination, or you can opt out of that and have a higher rate. But what we're seeing is if you go with the minimum down payment, the 20 or the 25 based on units, we're seeing what you're saying, high fees, meaning I'm either going to have to jack the rate up because the loan level price adjustments have changed because of COVID. So you're either going to have to pay a lot of discount points, or it's just, and in my opinion, it's easier to put the extra 5% down than take this really high rate if this is a long-term hold for you, right?
Yeah.
So one of the things a lot of my investors have done, I have, I know it's one that Matt knows, I just refinanced all 7 of his investment properties. We just got them all down super low rate. But another investor I have, we just refinanced all of her properties and we max cashed out each one of them so that she could turn around and take that cash to invest in more. So we're actually in the process of getting ready to close another one, a new purchase for her. But, with interest rates at an all-time low, if you can strategically keep yourself 5% above the minimum for whatever loan type, whatever type of property, you're always going to get a much better interest rate and you will get away from all those extra high fees that you were asking about.
No, that was awesome. That was so much info. So to summarize, if I can feed it back to you, there's going to be a minimum of 20 to 25%. However, best practice, if you have the money to get the best fee structure and rate, is to put an extra 5% down of 25 to 30% down on your purchase, right? So we're going to talk about a cash out refi later. Let's maybe just focus on the purchases for right now, because the cash out refi, if anyone on here has some rentals already, I mean, that's a great way to tap your equity, obviously, without, maybe doing a home equity line or something like that and having that balance fixed. So I think we covered Nate's question number 2 as far as high fees. Let's jump into, and you kind of covered this, but let's not talk about vacation rentals just yet. Harry has a question about COVID guidelines on self-employed income affecting investment loans. This will go hand in hand with, a purchase.
Yes. So, I mean, standard guidelines apply with self-employment, right? We have to have most recent 2 years tax returns, year-to-date profit and loss, where taxes, I think, are due, next week now? We're to the point where we're going to be requiring those 2019 taxes and the year-to-date profit and loss for this year. If all of your properties are rentals, I mean, there still will be some type of profit and loss that goes along, maybe to follow your Schedule E or your LLCs. But what has been additionally put in place because of COVID is, obviously, depending on your source of income, we've been asked of self-employed borrowers to get business bank statements or personal, if you don't use a business account, to show that funds are still flowing and you're still receiving income. Because when we're dealing with self-employment, it's not like an employer where I can call up and say, hey, are they still have a job and do I have pay stubs? So that's been an additional thing that's been put in place that I know has been, there's a lot of pushback in the industry, right? People are not happy about having to provide those bank statements, but it's literally just to source and show that there is still an income stream coming in and that there's expenses still going out, so that we know that there's still activity with the business. Okay.
So maybe one of the guidelines that has changed or added to, everything else is for the most part the same, but it's just that secondary source of verification for self-employed with bank statements.
Right. Yeah. It's just to show income stream.
Okay, cool. So in general, this is going to apply to probably any process, but let's go back to that just to kind of summarize, like for an investor to be ultra prepared, where have you seen people like get hung up and maybe, you know, not be successful in quickly getting their loan done? Well, let's just recap. What are some of the obvious things you as an investor need to continually have on the ready and updated regularly to be able to quickly navigate these loans?
So key thing is the tax returns, right? We've seen that be a big hiccup because a lot of people have taken advantage of the delayed filing. But when we get close to that filing deadline, as soon as that hits, we don't have an option. We have to have those tax returns. The IRS is not doing 4506 verifications right now. That is completely shut down for us. So the good news is for you, I should say, I think it's good because it doesn't delay our file waiting for that. We still have you sign the form. It's not happening. So having your tax returns on file, I always tell my investors the best bet. I mean, Matt's awesome when I need it. He gives them to me. Most people don't have those at the ready. Get your CPA on board with being in touch with me and letting them send me whatever I need. That's always the smoothest route. If I can deal straight with the CPA, there's a lot of times there's letters needed, you know, where I need things that, you know, just say, you know, there's nothing hurting to the business if we use these funds or whatever. So usually the direct line to the CPA is going to be a huge key. Keeping your P&L updated. It doesn't have to be audited. It doesn't need to be anything crazy. I mean, I've had people write on a piece of paper, income, expenses, total, that's it. I just have to have something that shows you're saying as a business owner, I'm still in business, I'm still doing business, here's what things look like so far year to date. Those would be kind of the two key things. And keeping your mortgage statements handy for all of your rentals. That's always kind of a hiccup. A lot of people have maybe somebody else that pays those or they don't keep copies. We always have to have the most recent statements. And another key thing, we're having a hard time getting credit reports updated to current. The mortgage companies aren't keeping on top of making sure they're reporting to current on the mortgages, and we have to have that. So our backup is to go back and get however many mortgage statements showing you've made your payment on time to offset that. Because if you try and call Wells Fargo, let's say, to update a credit report, you'll never get a live body on the phone right now. There's just not enough employees working. So those are just kind of key things to keep handy.
So one thing I'll add to that, because it always comes up on my files, is regularly be updating all this stuff like Holly said, but also like your bank statement, stuff like that. Have a system and process that is very easy to always have access to your statements online. So you can always download the last 3 months worth of statements and then be prepared to answer the questions of why is there a large deposit? You know, hopefully there are large deposits, right? But in my game of like, you know, flipping houses, you're always having all these big deposits because it's maybe a reimbursement of, you know, of rehab expenses, or it's you know, profit on a deal or something like that. You've always got to be prepared to explain, what is it? Everything above $2,500 or something like that?
Yeah, well, it's a percentage of income. So it's usually a percentage of whatever your monthly income is that we calculate. But
Okay.
I can tell you an easier route to offset that, if we're not using those funds, if those are only being used for reserves, because you're always required to have those as an investor, the safest route is if you have some type of IRA, something you're funding that you don't touch. I would rather see that all day long than deal with all the deposits on the bank statement. So, you know, if you're able to put some away and you've got something like a 401k or IRA or some type of investments, wow, that's 10 times easier than me going through and trying to make you document the deposits.
So that's a great tip right there. And this is going to answer some of the other questions, but what kind of reserves does an investor typically need to have in their account to satisfy the underwriting requirements of most lenders?
So here's what's funny is both Fannie Mae and Freddie Mac keep changing their guidelines. It used to be pretty standard across the board. It was 6 months. You needed 6 months payments for every property you owned. Now some of them have gone to a percentage of balance. So if your mortgage balance is X, you need 2% of your mortgage balance. But then we've got the caveat of what if you own free and clear, then you just have taxes and insurance. So I say that the safe bet is always 6 months of total payments. And if you don't have a payment and you're only paying taxes and insurance, then have 6 months worth of that on hand, because that's always going to be on the high side, right? That's the safe bet.
So is what you're saying, let's say I have 5 rentals, and are you saying, let's just make it easy. Let's say those 5 current rentals, my monthly obligation for my mortgage companies is $1,000 each. So if I have 5 rentals, I have $5,000 a month in rental payments, right? Mortgage payments for those rentals. Are you saying I would need 5 $30,000 times 6. So I would need to show $30,000
30,000.
in
That's
the
correct.
bank. Okay.
Correct.
Okay,
Correct.
cool. So that was one thing that I know people get, tripped up on all the time, is not so much knowing that you need to qualify like income wise and credit wise, but for these investment loans, you're also going to need to qualify with reserves and deposits for not just your new proposed loan, but for all of your existing loans that you currently have.
Correct.
Got it. So again, be prepared. Like if you're going after your fifth or sixth property, make sure you're going to have enough money in the bank to cover those existing fifth or sixth, the prior 4, right? So that you can qualify otherwise. So do you need to qualify every time for all of the other mortgages, like at the same time? Maybe I didn't ask that the right way, but say in my example, if I have $5,000 currently a month in mortgage payments, do I need to qualify for my income with those 5,000 monthly, mortgage balances plus my new one, plus all my other stuff? Or I guess what I'm getting at is from the income to debt, are you counting rental and lease agreements to offset some of those existing mortgage payments?
That's a great question, because I get that question quite a bit. So there's kind of a two-way street here. If you're buying a new investment property and you're purchasing it, right? We are going to take whatever the appraiser says the market rents are. We're going to use 75% of that to offset your payment. And in this current market, that's 100% of the payment, right? 75% of net rents is usually the whole payment.
Yeah.
When we're refinancing, or maybe you're buying a new one, but you own other properties and we're looking at that, we actually have a special calculation sheet that we use, and we go off of what you're filing on your taxes. So it's going to make a big difference in how you file, right? A lot of us use these investment properties as a way to get huge tax write-offs. It's great if you're doing that. If you're filing a Schedule E on your personal return, you're going to have your deductions and your what am I trying to say? What's the word I'm looking for?
Depreciation.
Anyway, yes, depreciation, that's the word. So you're going to have your depreciation in there, which is a great tax write-off. When we're doing the mortgage calculation, we have a special sheet we have to use where we're actually adding back in some of those expenses. We do give you credit back for the depreciation, and then we take from that number, we minus out the mortgage payment or any expense on the property. So it's not a straightforward, here's my lease, you get 75%. That only happens on a purchase or on a property that you haven't yet been able to file a tax return on because the next filing year wasn't due. So if you let's say you bought your first investment property today, and then you went to buy another one in December, I would still be using the lease agreement off the one you bought today, the 75% of that lease agreement, and 75% off the lease agreement of the one you buy in December. But come next year, once we get past tax filing, I will require that I need the tax returns to use the calculation. So it's kind of a trick, because buying them is a lot easier than refinancing, because usually you've written off enough that you're not offsetting the payment.
That makes sense. So again, make sure you're working with an accountant that understands the game of real the and how that's going to interplay with, your mortgages, right? And so that the attorney or the CPA and you can kind of all be on the same page to make sure you're not dropping the ball somewhere.
Well, 2 points here I want to make too that are kind of good tricks, right? A lot of smart investors, and that's one of them, will not file those on a Schedule E personal return. If you do them through an LLC, the trick is whatever the profit is of that LLC, whatever you're filing on your K-1 that's moving through to your tax return, if those properties are held in that LLC, we negate the mortgages. They're gone. We only use what your income is from the K-1. So it's a much better way to calculate, and it actually usually you come out a lot further ahead than if you're filing a traditional Schedule E. One thing I offer to everybody, and this is always an option, if you're looking at doing something, don't file your tax returns until I've looked at them. I'm not going to tell you to change your tax returns, but I can advise your CPA the way we look at income so that they might maybe rearrange the way they do things. Maybe they won't write off this as much, but they'll write off more here, things like that. Because there are ways to do it if you strategize. So, for example, I just talked to an investor today who's sending me over they haven't filed their 2018 or 19. They're sending them over to me to review first, to come up with what I'm getting income-wise, and then they can decide, do we want to pay more tax so that we qualify for more, right? So it's a strategy. You don't have to, I can always review tax returns and tell you, here's what I'm getting from the tax returns you have now, the way you have them, and you can decide whether or not you want to make changes before you file.
That's great. That's great. And you've done that with me many, many times before, and I've learned a lot to this whole concept of be prepared, because you want to be ready to go and fire away on a mortgage when you have the opportunity. So, okay, I'm going to catch up on some questions. 401k balances, do they count towards your reserve amount?
Yes, they do. We have to get whatever the hit is for the withdrawal, the tax hit. So they'll ask for the terms of withdrawal. When we get a 401k, we'll make you go to either the administrator. Sometimes we can pull them right off the website. We need to know the terms of withdrawal, because usually there's going to be a hit to taxes for doing that. But yes, we can use them. It usually comes out to about 75% or 70% of your balance that we can use.
Got it. Perfect. That makes sense. So a question, whoever iPhone is, sorry, it doesn't identify you.
The 10 mortgage question.
Is it true, married or not, you can only have a total of 10 mortgages? And I'm assuming they mean investment loans. What are mortgage options on investment properties beyond 10? You get this question all the time, and hopefully
I get it all the
we're
time.
all maxing out our 10. I'm not quite there.
So if you're doing it right, married or not, doesn't matter. You can each have 10. So if you're strategic in the way you file your taxes, you can still file a joint return. We're always going to be vetting who is on the mortgage. We have what we call a MERS report that we pull that'll show who's actually on title. We look at the mortgage statements, we verify all that. So the smart investor will make sure that if they're doing everything in an LLC, that they're splitting the LLC 50-50, so both of you have split income, and then that way you guys can both max out the 10 mortgages. Once you get beyond that route, it's kind of anyone's game at this point, right? It used to be, I'd say 3 months ago, we had lots of options for beyond 10. They all disappeared with COVID. So then you're looking at seller financing, hard money financing, private financing. I've got people that do it. The terms are usually not that great. The seller financing is the best bet, right? I know there's an investor that's here in my office right now that has more than 60% of his portfolio is seller financing, but we maxed out with what we could with his traditional mortgages first.
Yeah, and so then you may be going to like maybe a local bank or credit union that could maybe offer like a blanket commercial loan, like and maybe convert some of your properties into a commercial loan.
You could.
For the purposes of this
someday
question,
you can blanket those.
Yeah, you can have 10 in your name, your wife or your spouse or whatever. Like if you're married, you could have 10. So if you're partners in your deal, in theory, the household could have 20 residential mortgage loans in their combined names. For that would be for fourplex, triplex, duplex, or single family rental.
Correct.
Perfect. Okay. Let's clarify for Nate, as far as a vacation rental, because a lot of people, maybe want to do a Airbnb or something like that. This is actually a great question because
it is a good question. I get this a lot.
I'm not sure I know the answer. I have a lot of guys that are doing Airbnbs and their rents, pro forma rents are like off the chart, right? Like, how are you going to underwrite that?
Well, so unfortunately, the mortgage industry hasn't caught up to the Airbnb world yet. So what we still look at them as we do any other investment. So as you're buying it, we have the appraiser do a standard rent schedule and tell us what market rents would be on a standard rental. Now, the trick has been, so I've got one investor. She has 3 properties. She Airbnbs all 3. And as we purchased them, we had to do them as regular rentals. We've had to have her CPA kind of reinvent the wheel the way he files the taxes, and he has to file it as rental income, not really specifying that it is Airbnb. He's going to use the same write-off, very similar format, because if it is a nightly rental or an Airbnb, it doesn't actually fit into the traditional mortgage world yet. It's one of those things where, Fannie and Freddie are 5 or 6 years behind and haven't really caught up. So we're still going to look at things like we do a regular rental. The funny thing is, if you're doing an Airbnb, you're probably making 3 to 4 times what you would on a standard rental. So if you're just structuring it the right way with your CPA, it's going to look like a rental anyway. It still is a rental. A rental is a rental, whether it's this or that, right? And it's just a matter of how you file your taxes. And we're going to look at it the same way we would if it was just a long-term regular hold.
So maybe the follow-up question to that would be, let's say there is no rental history and would you underwrite that and do the loan as if it's just a second home? How many second home loans can you have and what are the underwriting requirements for those?
So second homes have to be at least a minimum of over 50 miles from your home. So they can't be within, a close area of your home. Second home rates are almost identical to to your regular owner occupied. I wouldn't recommend that route. I mean, as a second home, you lose a lot of tax options there. Like I said, on the purchase, we're still going to have the appraiser do a rent schedule, and we're okay. It's when we come to refinancing it, you should be still filing your rental income. Literally, again, it's semantics, right? It's how they're wording it on the tax return. I've done this lady's loan several times. I've been able to use the income, but we had to kind of strategize and make sure that, we weren't, the nightly rental thing, it doesn't compute in the mortgage world. It should, right? We all know that there's a greater income there. We know so many people are doing that with their properties. But again, we're going to look at it like any other rental. So second homes, you can own as many as you can qualify for, but you have to qualify for the whole payment. You cannot rent a second home. So a second home, technically, you cannot be rented at all, and you have to be able to occupy it at least 50% of the time.
Got it. Hopefully that answers that question. Nate, your other question about commercial, and Holly, comment on this. From my experience, Nate, maybe you could hit up Tim Watke after this call and get his take on this, because I know he's done a lot of these. But my experience is like your local credit unions and local banks are going to be your best route to go for commercial loans, and or just a traditional commercial mortgage broker like Holly, but it deals with commercial. I know Paul Winterwood's very active in the local RIAs at Bonneville multifamily. I've done really good loans with Weber State Credit Union. They have a good loan. MacU has a great commercial loan product. I've seen a few of my borrowers refinance with MacU loans on different properties, specifically in Idaho. But, I have a MacU loan. I have a Weber State Credit Union loan. I have a Bank of the West, like a more of a regional bank, out of California. They did my loans on my 2 apartment buildings out in Tooele. Everybody has a different appetite, is my experience. Some are going to be better at a smaller balance, which is usually $1 million or less. Some are only going to look at stuff that's, more than $1 million. It seems to me that $1 million loan balance is kind of the magic number for like who's going to be interested in it or not. Under $1 million, which these days, I guess for a commercial loan, it seems like everything's probably over $1 million bucks, right? Like that's, 5-plex or above. But I think you're going to have the best luck with credit unions, local banks, and then a mortgage broker. So any comments on that, Holly?
I have similar, feedback from people that are doing the commercial. I have a couple contacts in the commercial world. I actually have an avenue where I can kind of broker to a commercial guy. But my experience so far hasn't been that, I take my file, but it doesn't matter. The stuff that I'm giving him, what you need for commercial is totally different, right? They look at the income on the property, not your income. So, the local banks have always been the best source. I haven't had anyone yet try out Alta Bank since they changed names. But when they were Bank of America Fork, people were telling me all the time that they were really great to work with on those. And I've heard if you bank with Holiday Bank and Trust, they're just a one location, but I've been told they're really good for those too.
I actually, back in the day, I have had a loan with Holiday Bank and Trust, and I've seen some letters of intent or whatever, some pre-approvals from Alta Bank. So they're probably a good option as well. All right. I do want to talk about a BRRRR in a little bit of detail, but let's keep answering some questions. So question from Nate Worthen again. If I'm seller financing a deal to a buyer, so Nate's seller financing a deal to a buyer via contract for deed, can I get a mortgage on that real estate? Or is a notice of interest on title going to be a non-starter for an underwriter?
Okay, yes, because we are only going to lend to the owner of record. If there's a notice of interest on there, that's a problem for sure.
That makes sense.
Now, kind of a flip side, if you can find property where you can get in and maybe seller finance it, and you're going to do some rehab before you turn it into the rental, and it's going to be worth quite a bit more, meaning you'd have a much lower loan to value after that is done, and you wanted to wait to get the mortgage on that until that point. If you're able to get seller financing, as long as it's recorded, we can turn around and do a refinance, what we'd call a rate and term refinance, right? Anytime you want, from the time you bought it, even 3 days after. So that's a really nice caveat to have if you're going to maybe do something to, renovate a property that was not in good shape. But if you, put your money in the down, anyway, it's just another avenue. I just wanted to say that's available.
Cool.
It's called delayed financing. Yeah.
And Travis Barker, if any of you guys need a really, really solid builder, Travis has a ton of experience. He used to work for Ivory. He just anecdotal mentions that maybe Alta Bank isn't that great right now. He's had maybe some construction loans pulled away from Alta Bank. So for what it's worth, you know, there's some feedback there. So, okay, we got about 10 minutes left. Okay, let's jump to Tim really quick. Are owner-occupied jumbo loans still around for cash-out refi?
Ooh, that's a good question. So that's another big thing that went away with COVID. We basically got all government loans for a moment shut down. No FHA, no VA, no USDA, no jumbo, and they've all been coming back in line. I do have a source. So 90% of what I do is here in-house. We are a correspondent lender. We fund with our own money. We have over 28 investors we sell to. None of my investors are taking jumbo loans. I have a broker option. So Washington Federal, I have a really great contact over there. So yes, they're still out there. They're hard as heck to find, and they're not great as far as rates. In fact, some of the news articles I'm reading daily is like, why are we punishing people with great credit that just happen to have jumbo loans? And that's what's happening because of COVID, because everyone's reducing risk. So jumbo loans, they're higher risk. They're kind of off the table. There is an avenue, but it's not the greatest right now.
Cool. And then that answer would apply to the cash out, right? Like if they're not available, you're certainly not doing it cash out right now.
Yeah, and they're doing them. Like I said, I have avenues. It's harder to find. They've lowered their loan to value requirement. So you might have been able to cash out to 80 and maybe now you can only cash out to 65, right? So it's definitely, everything's restricted. We're kind of hoping as COVID goes away, this all comes back, but you know, it's a sit and wait kind of game right now.
There you go. Tim, time to move to Tooele, man. Let's get a little smaller house for you. I'm just kidding. All right, let's go through. I want to go through in the last kind of 15, 20 minutes here. BRRRR. Everyone hears BRRRR. So I see so many people get fouled up on really how to do a BRRRR because a lot of times there's things you do when you purchase it that you're not thinking through how it needs to look when you go to refinance it. So let's walk through, as you would see, the most successful way to do a BRRRR, right? So let's walk through an example. I don't know, pick numbers or whatever, but let's talk about like how you need to take title, how with the best way to recapture if the values are there, your original purchase funds and rehab funds. And, you know, like to successfully do a BRRRR, in my opinion, you want to be able to buy it either with cash or private, like a hard money loan, rehab the property, create enough value that when that appraisal comes in at either 80 or 75% of, you know, value, which you can get that the new mortgage for, that amount is going to be able to pay off your rehab funds and your existing lien or your cash, right? So walk us through a BRRRR.
Well, I mean, one of the tricky things is people never want to put title in their own personal name. And that's fine. If you want to buy in an LLC, as long as you're the managing member or a member, right, you can do that, but we are going to have to transfer title in the process of doing the loan. We can't do the loan in the name of the LLC. So tricky thing, I mean, it may be I don't know what the exposure is. I'm not an attorney. I can't really tell you, but it really does muddy up the waters when you're not putting title in your personal name. So that's preferred if you can. And as far as the loan, record everything, right? So if you're able to, I'd say the best route, let's say you're paying cash for the property and maybe you're hitting up Matt for hard money to fix up the property, record them simultaneously. Any lien that's recorded after the date of purchase, when you go to refinance, is considered a cash out. That limits the value of what we can lend, right? So the key thing would be get all your money, record it all on the same day as purchase, record it simultaneously. That way you don't hiccup when you're trying to get that money back out, right? And yep. I think, you know, as far as the rehab goes, if your value is coming in extremely high over purchase, over what you took out, they're going to want to see documentation of what you did to rehab to justify that. So key thing, and Matt's been through this with me before, is keep your receipts. Have a good accounting system where you've kind of got that all set. Maybe look at yourself like a construction lender and do it like almost like draw requests, right? Where you have everything kind of mapped out and you have the receipts attached. In any case, you should always have that available. We don't always need it, but I would say that's something you definitely want to have handy.
Awesome. So think through why you're buying the property, and you don't always know, right? Like one mistake I see people make all the time is they originally bought it as a flip, but it doesn't work out as a flip because they're not going to make what they thought they were going to make. And then they're like, oh, we'll just keep this as a long-term rental. That's a great idea. But they did what you just said not to do, is maybe they bought it in an LLC, which maybe for the flip made a ton of sense. But then, 6 months through, they're like, oh, this actually sucks as a flip. It needs to be a rental, right? And then they deed it to themselves so they can get the personal loan on their new mortgage. And then they have to wait longer, right? It eats up interest, on your hard money. And it just ends up not being as efficient as if you would have from the get-go said, I am buying this as a rental. I'm buying it in my personal name. I'm going to structure my purchase loan the right way so that I can refinance out of it. So I see that all the time. And sometimes maybe you don't know, and maybe along the way, you're not so worried about the timetable and it's in an LLC and you can wait another 6 months or a year after deeding it to yourself, right? And then you can refinance it. But if time is of the essence, you got to think through how you're going to put yourself on title from the get-go.
Right. Absolutely.
Okay. And then the other point, which is so valuable, and I'll just interject a little bit about, maybe how we do hard money loans, right? Like, so if let's just use a really simple example, Holly, what would be, so let's say the future value of this property is going to be 300,000. Okay. What typically are you going to be able to fund as a new mortgage down the road? 75% of that?
So it's the same as purchase. Rate and term is the same, right? So if it's a single family, you're going to get your best rate and everything at 75%, right?
Okay.
So you're going to want to try and keep it at that, right? Now, if it's cash out, you're going to drop that by 5%. So if you are trying to pull money out because you didn't take out a lien for the rehab costs or you did it after the fact, and it's a second lien that got put on even a day after, then you're going to be 5% lower. So single family, 75%, maybe it goes down to 70 on a cash out. And again, every time you can go 5% below the minimum for whatever you're doing, you're going to get less fees, way better interest rate.
Perfect. So keynotes there, cash out typically at 70% or 65%?
65 or 70, yeah. And I can tell you that gal that I just cashed out all of her properties, we kept them at 60. And at doing that, her interest rate was like a half a point lower. That was kind of the sweet spot, right? And that's another thing where you can call me. I can ballpark that. We can run rates because there's a lot of factors, right?
And if it's a rate and term, you're more like 70 to 75%, 70%
right.
more of get the sweet spot of the best rate.
Right.
So
absolutely.
So if we were to let's use my example and just kind of hopefully go through one that will make sense. So if we're thinking through when we buy a property, we're like, okay, I know that I can probably get an appraisal for $300,000 on this property after I buy it, rehab it, rent it with a good renter, right? I'm going to be at 300,000. So then what you do is you say, to get the best rate possible, my new loan amount, in 4 or 5 or 6 months is going to be 210,000, which is 70% of 300,000. So let's say the rehab is going to be $20,000. So now you're $190,000. Let's say there's going to be the transaction costs of title as well as the hard money of another $10,000. So now you're down to 180. So if you could buy this property for say 180 or less, you probably could do a very successful BRRRR where if you structure it right from the get-go, you could buy it for 180, do a hard money loan. Maybe you get a second hard money loan for the $20,000, right? And so what we want to get at is your final purchase money mortgage on your private loan has a payoff on or around the $210,000 mark, right? Because then you'll be able to do a rate and term, pay off all of your existing purchase money loans, and be out of pocket after 6 months, essentially no money out of pocket, right? And so you just got to always be thinking through, just like you would have flipped, but what's my future value? What's the bank going to lend me? Somewhere between 70 to 75 for a rate and term or 60 to 65 for a cash out. Am I buying the property well enough that I can do what I want to do to get my purchase money, hard money or private loan paid off, as well as my rehab money? Because if not, Holly, what's going to happen? You're going to have to leave some of your money in the deal, right?
Absolutely. Yep. You're not going to get all your cash back. And another thought to put in there is make sure you're factoring in loan costs when you do the refinance, right? We can roll them into the loan. If you're not wanting to bring those out of pocket, factor at least about 3% of your loan amount for total loan costs, into that as well.
Perfect. And so the underwriting guidelines might be different for commercial loans, but essentially I've been able to do that exact same thing with commercial loans as well. But you always got to be thinking through, what is that final value going to be? What percent is the bank going to fund? Then from that percentage, back out your rehab, your hard money costs, your transaction costs, ultimately get to your purchase price, right? And then you will be successful. So many people don't think through that. And then it's like, well, crap, I was hoping to get all my money back out, but man, I'm gonna have to leave my rehab money in there. And that's great and that's fine. But as we know, investing, you only have so much money where, like, if you're always leaving 30, 40, 50,000 bucks into every loan, at some point you're going to run out of cash, and then you got to get creative to, have partners or whatever. But anyway, so just think through that. It's harder to do the BRRRR these days, but if you can get a good deal on a house, you can really screw it up if you don't intentionally think about how it needs to be set up. And, again, just repeat what you said. Think about title up front. Think about how you're structuring your purchase funds so that those could be recaptured in a rate and term rather than a cash out, because you're going to get more loan to value on a rate and term and a better rate.
Lower interest rate for sure. Yeah.
Yep. Cool. So that's great. And so this can be very complicated. So reach out to, Holly, if you guys have any questions about that. So, all right, as we kind of wrap up here, we've kind of talked a little bit about this, but anything else you want to add, but where do you see investors screw up? We've kind of maybe touched on this, but where do you see investors screw up where it's just aggravating and frustrating, and things you could maybe point out to help us, not screw up ourselves?
Right. I would say, like the two loan thing has been the biggest, where these turn into cash out refis, because all the time I'll have people, they'll go take out the hard money, and then they'll realize, oh, I don't have enough to do everything I want to do in this property. They'll go pull whatever, a second, or get some more money. That simultaneous, that's a huge, if you can do that up front, it's going to save you so much in the end between rate and everything.
So
another big one.
Just explain that again so it hits home. If you end up needing, in our example, $180,000 to purchase the home and or to do the rehab combined, what you're saying is you got to figure out a way.
Take it all out day one.
Day one, right? Because if you do a first one day and then a second 2 weeks later, that second's really not going to be considered rate and termable, if that's a phrase.
I've even had it in the same day, Matt. If the settlement statement on the purchase doesn't show all liens on that settlement statement, it's a cash out. So even same day, if you're trying to do, well, I've got this lender that'll give me this, but then I'm going to go later and get this money from this guy this afternoon, it needs to all be done in one transaction, or it's a cash out refi. Has to be done at purchase. So that needs to all be on one settlement statement. That's a huge thing that I've seen people get caught up on a lot. The title issue, like we talked about, is a big one. Sometimes if you're dealing with these, these wholesale deals where we're transferring title, we can't lend on them until you've been on title for a certain amount of time. So that's another big one. I would say the biggest thing that I see, though, that almost is not something we've talked about, is everybody underestimates what they're going to need to rehab. I think if you don't have a lot of experience, you really need to lean on someone who's done it. When you're doing these flips, and I've done it myself on a flip, you think, oh, I can get in there and get out of there, do everything I need to do for 30 grand. And then you get in there and you find, issues, find electrical issues or plumbing issues you couldn't see, or something that just ends up costing more, right? And so underestimating is a huge thing that I see, where people end up, then they've got money left on the table they can't use.
And so we could probably go through a gazillion different examples, but so reach out to Holly with specifics. But, even if you're paying cash, what's a creative way? Let's say someone's paying cash, but they want to recapture in a rate and term down the road. What would be a creative, legitimate way, right? Like, not fake.
Lend themselves the money.
Okay, so how do you document that? Because you could do that if you're lending yourself the money for a second, if you get most of it from, a hard money lender. How would you document lending yourself the money at the time of purchase on the original settlement statement so you can do a rate down the road?
I would create yourself an LLC that has the money to lend, right? So if it's Holly Stirling LLC that's going to lend Holly Stirling money to buy this flip, I would make sure that wherever my source of my funds is, because we're not going to document the source from the lender, right? But we do if it's coming from you. So if, let's say I have an inheritance, I've got a couple $100,000, I want to go rehab this property, but I'm going to want to put a mortgage on it, and I don't want to take the cash out hit, which you would if you paid cash and didn't finance. I'd go and record a deed against myself, right? I would use the standard method of recording a mortgage that I owe myself for that property.
That's
the key is recording.
The key is
recording. It needs to be recorded with the county.
And back to your point, if you're buying the property right and you maybe overshoot your budget, I've done this before. at the time you purchase it, allocate maybe a little, but you actually have to, you can't just fudge this and have it be on paper. Like if you're recording a mortgage and a deed for yourself of say, let's go back to my example, right? Like let's say you're buying it for 180 and it needs 20 in fix up. Let's say you record a mortgage for, 210 or 220,000. Right? So
I've seen this happen where they don't, and they don't use it all. When you get the payoff.
Use it all. You'd rather go backwards and like, discount your payoff or whatever than be short money. So always be thinking through that. You could set it up, and I've done this before. We have in our hard money loan documents in the way of an additional advance where we record actually a higher amount than we're actually funding, so that we could advance money if we needed to, if the borrower gets in a jam, right? And we need to advance them money. But the same thing would work for yourself, where you don't actually need to fund that money, but you do need to have it recorded and have it documented the right way that it is functioning like a construction draw. And then you
can like a HELOC.
A rate and term. Yeah, like a HELOC. And then you still can do.
It looks like a HELOC.
Yep.
Right. You're recording the max amount, but doesn't mean you've drawn it. So the payoff is where we'll get that, evened out.
Awesome. So just don't paint yourself into a corner. Give yourself all the options available to you from the get-go. And then last point, we really don't really talk about the exact timing. Typically, every investor is going to be different. How long do you need to be seasoned on title from when you purchase it to when you'd be able to do either a rate and term at the appraised value, not the purchase price?
If it's in your personal name, literally day 2. So if you've bought the house in your name, you've used hard money financing, it's called the delayed financing rule. We can literally refinance you day 2. And sometimes I do that. We prep the mortgage file and have it ready. I mean, obviously we're not going to close day 2 because of the 9-day minimum timeline on disclosure, right? But we can have your file already like a pre-qualification, have the file ready to go. You buy the property. If you're getting, let's just say you're getting a steal, right? You're not even rehabbing, you're just getting a steal. You go use cash or you use your hard money to get the deal. I can turn around and we can start the loan day 2 and have it done. I mean, minimum is 9 days, but we can do it right then.
Awesome. So I'm just regretting after all I've done with you, I just bought a property and had some extra funds, but I probably have a lot more value because I got a good deal on it. I didn't, right? So we're always learning. I didn't record a sneaking deed or a mortgage on it because I used, outside funds to do it. And anyway, so we're always learning.
You could still do the deal. You could still do it. You're just going to be doing a cash out instead.
Cash out. Exactly. All right, cool. I guess the point of this is all can be overwhelming, and I'm still always asking Holly questions after 20 years. If it's not Holly, find a very competent right person that you can ask these questions to ahead of time, right? Before you get into the deal, so you can kind of think through, even if you're not going to remember all this stuff right now. So, all right, Holly, I like to keep these strictly to an hour. I am starving, so I'm going to be going to Greek City Grill right by Greystone Mortgages to get some food if anyone wants to meet me there, Anyway, but any last thoughts?
No, I just, whoever it is, whether it's me or somebody, get a mortgage partner and always ask the questions first. It's always better to bounce the ideas off them first, to have them look at the tax returns first, just so that, you don't make those mistakes down the line. But I know I have lots of friends in the business, and those of us who've done this a long time and know what we're doing, we're more than happy to kind of be your sounding board for that.
Awesome. Well, I did drop Holly's info a couple of times in the chat room. So you've got her cell phone and her email. Holly, I will be talking to you shortly, I'm sure, maybe even this afternoon about a deal that I have a question about. So thanks so much for the time. And
thank you.
Go get busy with those loans you got piling up on your desk.
You got it. Thanks, everyone.
All right. Thanks. Have a good day.
You too.
Bye.